Here we've got a market cap 20 billion, a big chunky company. Price earnings of 15, which is maybe a little on the tough side, but dividend yield 3.7. These retailers are really paying out dividends in that space. Let's start with you, Chris. Operating margins, this is one of the spaces these guys really do well. Theirs isn't as big as some, but still 22% operating margin, those are chunky numbers.
Still very good. Look, let's not forget, until about, I guess, 10, 15 years ago, this was the benchmark by which all clothing retailers were measured in South Africa. Since then it's diversified a lot. It's got into very different areas. Things like the sports side, for example. They've got quite a lot of sports operations, and so it's very diversified relative to a lot of the other players in there. And that's perhaps one of the reasons why the margin is a bit different. But nevertheless, you know, it's come back in the past couple of years under the new CEO, Doug Murray, and I think he's done a tremendous job in turning this company around. It was never a bad operation, and I think we've got to make that point, that the clothing retailers in South Africa are some of the best you're going to find in the world, and Foshini is right up there with the best of them.
Well, Craig, let's get your sense with regards to Foshini and the trading updates. Do you think that these are fair numbers? And I suppose the question is, and the question on everyone's mind is, how much longer can we sustain these growth levels of 22% and perhaps above?
Yeah, well, look, the growth needs to be seen in the context of the prior year, where they actually lost 6.8% in earnings. So if you take the last 2 years, they've only averaged about 6.2% growth in earnings, which isn't exciting. The last 3 years' dividends have been exactly the same, R2.88, and so those are aspects that make me a bit worried about what the next year will deliver. There hasn't been that consistency as perhaps we've seen in Truworths or some of the other groups.
And Craig, their RCS, which is their card, which they're offering it around, and I got to say, I get far too many SMSs and pieces of dead tree in the mail offering me money from them. Interesting space in the sense that they can start white labeling it, so now they can potentially roll that out. Now, there's pros and cons. The con is that they're becoming a bit too much of a bank, but I think all of our retailers do that. The pros, of course, is you know, nice bolt-ons for perhaps other retailers and the like to quite easily get a store card of sort.
Yeah, there may well be a story behind that going forward, and I think, as you correctly said, many of the retailers are making financial services a far larger part of the offering.
Chris, with regards to you know, Craig alluding to the fact that yes, it's off a relatively low base, what kind of growth, what kind of earnings are you expecting for this company? I mean, PE sitting at around 15, you know, we still have unemployment that is quite high, but then again we've got wage increases which are above inflation.
I can see them sustaining this kind of growth for the next year or two. One of
so 22% or so, around there.
Yeah, right about the 20% growth. And that's getting back to the kind of growth we had 15, 20 years ago. I mean, they're quite capable of doing it. With one caveat, and we have to bear in mind that interest rates are at a low. They're not going to go lower. If anything, they're going to go higher, probably from about the first quarter of next year, maybe even earlier, depending on what happens in terms of extraneous factors in the rest of the world and what happens here, which that in itself will make it more difficult. But having said that, I think all of the clothing retailers, the credit clothing retailers, have showed an exquisite ability to maintain, to run very, very well-run books, and they've been far more adept at offering credit to the masses than the banks have been. So I think, you know, while
they're better bankers than the bankers.
Well, I didn't say that, but they're perhaps more in tune with what is required at the lower end of the market particularly. And that's been demonstrated, and they've got great books, all of these players.
What about, I mean, one of the tricks I see that they're doing is they're paying, what do they say, they pay 30 days from statement. They're almost kind of moving into their pick and pay model. They've got their stock holding coming down. You're kind of money in before you actually have to pay out from it, and that's certainly the classic from pick and pay. Foshini's quite proud about doing that. Is that space retailers can sort of squeeze a little bit of extra margin out of?
You can, provided you've got the data capability, that you know what is selling. You know, I mean, you don't want to get landed with a whole bunch of stuff that you've got to start marking down, because that really starts clouding the waters dramatically. But provided, and I think Truworths is probably the best example of all of these, if you know what is selling, where, how and when and to whom, if you can get that stock moving, that's the key to it.
Well, Craig, your sense on that, because essentially what we're seeing here, and obviously as Simon alluded to, the same kind of scenario that's playing out with Pick and Pay, is that creditors are basically funding the company in a sense. Could the 30 days be moved to 60 days, 90 days?
Yeah, look, some of the retailers are struggling with operating margins, and so the way to try and enhance earnings would be going back to those suppliers asking for settlement discounts, etc. So we are seeing some of that where the periods of payment are shorter, and of course it's been enhanced with settlement discounts and other offerings.
Chris, what about Walmart and the strong rand? Maybe not operating in the same LSM to the same degree, but certainly Massmart, Walmart coming, the rand getting stronger, imports. Are we going to see, Massmart sells a bit of clothing, but at their macros and the like, not much. Are we likely to see those folks really up the ante in the space, looking at these really juicy margins?
You only have to look as far as what Walmart does with Asda in the UK. They've taken the George brand. That was George Davis who started the Next group across there many years ago. And they've done exceptionally well out of clothing. I mean, you can buy a pure cotton shirt there for 10, 12 pounds. I mean, you can't do that in this country. It's just not possible. So the quality is there, and the pricing is there. They source most of this from China and other parts of the Far East. If they so desired, they could probably try and replicate that. But I think that's quite a long way off. And as you rightly say, Truworths, Foshini, Woolies, different segments, different categories altogether. So I don't think it would really
maybe more hitting the Mr. Price, probably that sort of
Mr. Price and lower.
And lower even down.
Yeah. Well, Craig, I'm glad we are mentioning the likes of Mr. Price, because they're also coming out with a small credit offering. We know that they're very big within the youth and various lower LSM markets as well, and perhaps breaching into other sectors. The competitive environment within the clothing space seems to be quite rife at this point. And if Mr. Price does steam ahead with a credit offering, could that be a very big issue for the likes of Foshini and Truworths down the line, would you say?
Yeah, I think it may well be an issue for Mr. Price themselves. What worries me with them offering credit is the operating margins are much lower. I think we're 7 or 8% sort of operating margins as opposed to 21, and Truworths on the 26 sort of side. So that's certainly a concern and will have to be looked at. And right now the market sees them as a very low cost offering. So they probably would have to make some pricing adjustments if they're going to get the credit right.
And so, in other words, no real threat to the likes of Foshini and Truworths at this point?
Not in my view. I think where Mr. Price is focused is on the rest of the African continent. They've indicated perhaps going into Nigeria, because there's been some changes in terms of importing of clothes and allowing foreign clothing retailers in there. So that's probably where they are focused, not worry about the local market too much.
Craig, you mentioned Africa there. It's the one thing which we don't see much our clothing retailers doing, is going across our borders. Is that logistics? Is that just that they're doing so incredibly well here, they don't see the need to sort of move into the rest of Africa?
Well, look, I think clothing's quite a unique thing in the African continent. You recognize if you're from Kenya and so on by your attire and dress. It's not one size fits all, if I can use the expression. So yet the Nigerian market's obviously very exciting for Mr. Price. They've obviously researched what sells there. But I think one has to be very selective in terms of what markets one would enter.
Yeah, Chris, your sense with regards to that? I mean, the Africa space and the margins are very high on the rest of the continent relative to here.
Yeah, but one of the problems you've got with all retailers is supply lines and logistics, actually getting the product into the rest of Africa. You do have certain of our retailers, I mean, companies like Pep, for example, I mean, they've been in there for a while. But I think there will be a growing market for companies like Foshini, Truworths, Woolies, because as you have that emerging middle class with much more in the way of money, more spending power, and greater aspirations, I think these are tailor-made, if you'll excuse the pun.
What we may be seeing is there was that rush off to Australia by our company, and no one really got it right. Perhaps a bit of caution into Africa is not the baddest thing out there, because we're not seeing, the construction guys are, but frankly they're a little bit desperate.
Yes.
The retailers are saying, let's do this slowly. I mean, ShopRite's kind of leading the way, but there are issues around supply. As Craig says, there's issues around what people want.
Precisely. And look, the rest of Africa is a very, very different proposition to Australia. Australia is a first world developed country, and Truworths realized that, 10, 12 years ago, and they made a foray in there with Sports Guild, and it didn't work, and they got out very, very quickly, cut their losses. So Africa, you know, as you rightly say, I think softly, softly catching monkey, I think the demand will develop over time.
Hot or not?
I think it's reasonably hot. I wouldn't say, you know, absolutely stonking hot, but no, it's fairly hot.
So in other words, you would be allocating some money to Foshini at these levels?
It's well worth looking at this point in time, I think, yes.
Fantastic. Craig?
No, Foshini wouldn't be my preference, not hot.
what would be your preference within this space?
Truworths, I prefer Truworths, and Woolworths also has quite a lot going for it, especially in the shorter term.
Okay.